Hey gang, welcome to Time in the Market, the investing channel with a long-term focus, or as my mom calls it, the worst channel she's ever seen. But what are you going to do? You can't please everybody. This is the second in a many-part video series that I'm going to do on this portfolio that I have that I'm putting $500 a week into, and I thought it'd be kind of fun to track its progress, share it with people, the 7 people that watch this channel. Hey Steve, thanks for watching, and then see how it does in the long run. When I did my first video in August, this portfolio was somewhere in the neighborhood of 62,000 bucks. You can watch that video. I will link it in the description down below. Now we're sitting at 81,000 with another $500 going into the market this morning. Kind of fun to see that sort of progress. Obviously, the market's been on an upward trajectory in the last couple of months, in the last couple of years, really. So it's not too hard to go up when the market's doing that. It'll be interesting to see how this portfolio does when and if the market starts moving in the opposite direction. And really, I focused on companies that I think will take advantage of market conditions like that and do well in market conditions like that. And by do well, I don't mean they're going to go up in price, but I mean they're going to be able to buy back shares at affordable prices, make acquisitions, and really benefit from tougher market conditions because they're financially steady companies that do well in good times and bad from a financial position. And this portfolio's changed a little bit since the last update in August. At that time, it had 39 stocks, which was way too many. I talked about that in the last video. I wanted to pare it down to 20 to 25 companies, and I've done that. Now we're down to 20 companies, and really wanted to focus on companies that are going to compound my wealth through good times and bad. And that's not just dividend payers. Really, the last video was focused on dividend growth, and that's changed since then. Now it's, yes, these companies pay dividends, but they're also going to buy back shares. There's going to be M&A activity. They're going to invest in the business internally and make smart decisions with the money that I'm investing in these companies. And that's going to be a good thing for long-term returns. We'll see if it actually pays off, but hopefully it does because I do really believe in these companies. And now having 20 companies is going to mean that I can follow them way more easily. And on top of that, this is the cutoff for the portfolio on a go-forward basis. I'm never going to be above 20 companies. If I want to add something new, that means I have to remove something else, which will be a tough decision, but it'll be more fun to be more concentrated. It'll help with long-term returns. And in general, this series is meant to be an enjoyable view for people who want to follow the growth of a portfolio of some random guy on the internet. As always, guys, this is not investment advice. Do your own due diligence. Don't invest in any companies that some random guy tells you to invest in, but hopefully this will give me a reason to keep investing in this, a reason to keep track of these companies, and a reason to keep making these videos. I won't make them too often. This is not going to be a once a week type thing because who cares about updates every week. It'll be a once every couple of months type thing where I get the urge to really do an update and share with you how this thing is doing. Maybe some random number. Hey, next time we hit 100K or something like that will be the next video. But if you want to see more of this type of stuff, let me know down below because otherwise I'm going to keep making overly long videos about random companies that 17 people watch and enjoy. Otherwise, you know, this is going to be the channel and that's what you'll get. So if you want something else, let me know down below. Like the video, subscribe, and all that stuff. So let's dive into these 20 companies that are in here now and then talk about the companies I removed as well. So I won't dive into too much detail about these companies because a lot of them are relatively well known. But if there's any companies in here that you're not familiar with and you want a deeper dive on, let me know in the comments down below and I'll try to do that. So to start it off, these are weighted to a target percentage. Obviously, the higher the number, the more of that holding I'll have. So TSM is my #1 holding, followed by Broadcom. Some tech representation, some worries about, you know, the AI cycle and how that impacts his business. Some worries about this company being based in Taiwan and tariffs and all of that stuff. All of these things to keep an eye on, but I think these are good long-term investments right now. And I'm not saying that these companies are cheap by any means. I'm not saying that any of the companies in this portfolio are particularly cheap by any means, but at the end of the day, I think this is a portfolio that's going to do okay through thick and thin. The idea is that, you know, 10 to 15 years from now, these companies are going to be a lot higher than they are today. They're going to compound my wealth at a good clip. And if that means that during that period, they're down 50% at a certain point, that's only a good thing for me because I'm investing $500 every single week. And the cheaper I buy them, the better it is for me. So I wouldn't be upset about a downturn when it comes to a portfolio like this one that's consistently being invested into. You have to remember that $500 a week on a $80,000 portfolio is a decent percentage boost with every addition of money. $500 a week means $2,000 a month, which means 2.5% of the portfolio's assets are being added every single month. So that growth is really driving the growth. It's the net cash flow that's driving a lot of the growth right now. It's not the market gains. The market gains will eventually be the bigger player in the overall gains of this portfolio, but right now it's very much net cash flow that is driving the 62,000 to 81,000 growth that we've seen in the last 5 months or so. We've got Roper, we've got Main Street Capital, a BDC, you've got S&P Global Inc. And a lot of these companies were in the portfolio before. They're just the remnants of the 39 that I had in there, and they survive the deletion that happened. So some healthcare with ABBV, MCOR, an infrastructure play that hasn't done that well recently, but I think is actually a pretty decent value right now. Got MasterCard, some financials. You've got Walmart, retail play that I think will do well if the economy struggles, or if it does well because people are going to go shop at the cheapest place, and Walmart is usually one of the cheaper places out there in a lot of areas. You've got Abbott, you've got CRH, another infrastructure play. Then you've got a couple of private equity plays, KKR, Hamilton Lane, Apollo, Ares. Apollo was the new addition. The others were in the portfolio before. And I think these are very much M&A plays. I think they're going to do well with this administration. There's going to be a lot of acquisitions that are out there. There's always some risk about the carried interest loophole being closed, things of that nature. And a lot of these companies aren't cheap by any means right now. They're probably a bit more expensive, if anything. They could use a little bit of a downturn. But again, I'm adding $500 every single week, and these are $3,000 to $4,000 investments at this point, so still very small in the grand scheme of things. If they do take a dip, 20, 30%, whatever, I think in the long run, they'll still do okay. They'll still compound well, but a dip wouldn't hurt them too much in terms of their valuation. You've got CTAS, you've got Waste Management, people need to get their garbage taken away. You got Sherwin-Williams, people need to paint their houses. You got Costco, which I also own in my individual active portfolio. This is not so much that, it's more of a passive investment cycle. You've got CRAI International, which I think will also benefit from M&A in this environment. So this is the portfolio. These are the 20 companies that are in here. I'm going to let you look at them again. Let me know if you disagree with any of these, that you don't think they're going to compound well in the next 10 years or so, and if you think there's other companies that should be in here that I should be thinking about replacing some of these with. I'll certainly look at any suggestions from anyone out there. Again, these aren't companies that are going to blow the doors off in terms of growth, but I'm also trying to keep a level of safety within this portfolio because I want this to be something that I can kind of forget about for 5 years and come back to and feel comfortable with that. There's a lot of stocks I invest in on the growth side in my individual portfolio where I kind of look at them as 5 to 10 year investments, but I'm a bit wary about them. When it comes to stuff like this, I'm more comfortable with these as 5 to 10 year investments. I'm comfortable with just putting $500 into this every single week, not thinking too much about the individual stocks valuation at that moment, and then just sort of seeing what happens in the next couple of years to a decade or so. And that's kind of the idea behind this portfolio. As we look at the prior portfolio, you can kind of see the old portfolio here. The companies that remained are in this new portfolio. I added Apollo, I added MCOR, I added Waste Management, but everything else was already in the old portfolio. And then you've got the 19 or 20 or 22 companies that were deleted. And there's a couple of reasons I deleted some of these. Some of these are just consumer staples, consumer discretionary companies that I think are going to struggle if there's any sort of economic downturn. There's also valuation concerns here. You've got companies that are growing in the low single digits, trading at 3% free cash flow multiples. I didn't really love that. I'm not saying that these are by any means cheap in relation to that, but it's just companies that I felt more comfortable with going into the next 5 years or so. A lot of these companies were REITs. You've got Vici, you've got Realty Income, a couple of others, FRT, ESS, ARE were REITs, and ADC as well. And honestly, having REITs in a taxable account, not the best idea. I wanted this to be more tax efficient. I didn't want the focus to be on dividends, especially dividends that you don't get a favorable taxable rate on. So REITs would go into tax advantaged accounts. That's why I removed them. And that's really the gist of it. You've got companies like Pepsi, Coca-Cola, Fang, McDonald's, CHD. All of these companies are solid. It's just that I wanted to pare down the portfolio and focus more on companies that I actually felt like were, one, either a good valuation, two, companies that I think had more opportunity for growth, and three, generally more companies that I believed in and things of that nature. And it's not that I don't believe in Coke or McDonald's or anything like that, but I just don't see the pathway for growth there. The valuation seems relatively expensive, and I just didn't feel like these could be companies that are going to deliver 10% plus returns. Because the idea here is to have companies in here that I think are going to have a pretty good shot at beating the market. And maybe some of these aren't going to do that. And, in a year or two, I'll certainly revisit this portfolio as well, and maybe even sooner, and say, well, I'm going to remove company A and replace it with company B. This is a very good starting point that I have here for potentially market beating companies that are going to do well if a recession were to happen, that I think are going to do well in spite of potential tariffs. They're going to do well in spite of inflation returning. And I just didn't feel that way with some of these other companies. So what do you think about this? Am I off in any way? Is this portfolio interesting to you? Am I missing any companies that you think should be in here that have been around for quite some time, that have stood the test of time, that you think are going to be market beaters? And you can kind of see that $500 a week, it's kind of fun to see this money flow in, to have money basically flowing in every single week into a portfolio, see that growth, see how quickly it can happen, how a lot of that is driven by cash flow, but also market gains. And then, year to date, we've got $4,000 in cash flow, $4,000 in market gains, $200 in dividends. So right now, in at least the last month and a half, it's a 50-50 type of return from cash flow and market gains. It seems like this new portfolio, the way it's designed, is certainly doing a bit better than what I had before. A bit more focus on growth, a bit more focus on long-term compounders, and a bit of a less focused approach to dividends. And yeah, that means from a dividend perspective, my dividend income is going to drop in 2024. I had $1,300 in dividends in 25 because these are less yielding companies. It's going to be down to $1,100 or something like that. But I don't care about that. I'm still relatively young. I'm still looking for overall growth, tax efficient growth, and this new portfolio certainly does that more than the last portfolio. On top of that, it's more concentrated. So if I have winners in here, the returns will be more concentrated for me. Obviously, if I have losers in here, that'll be the reverse as well. That's the risk you're taking. So let me know what you think about the portfolio. As always, guys, this is not investment advice. Do your own due diligence before making any investment decisions. Just thought it'd be fun to make another update. Let me know if you want more of these updates. Otherwise, I'll do them, every 5 to 6 months or so, not too often, and they'll focus more on the individual stock videos that I've been doing. But otherwise, thanks for watching. As always, leave a like, subscribe, leave a comment down below, all of that good stuff, as people say on the YouTubes. Have a good day, and bye.